Okay, so Stryker, the medical technology giant, just dropped its third quarter earnings report, and wow, the numbers are telling a pretty powerful story. We're going to deconstruct their incredible growth, their really smart strategic moves with robotics, and also how they're handling some major challenges. Let's dive right in.
So let's just start with the big headline number, 9.5%. That is Stryker's organic sales growth. In an industry where getting mid-single digits is usually considered a solid win, this is a seriously strong result. And remember, this is on top of an already strong performance last year.
And it gets even better. They didn't just grow sales, they backed it up with an 11.1% jump in adjusted earnings per share. Look, getting double-digit growth on both sales and earnings, that's the kind of performance that investors absolutely love to see.
And you don't just have to take my word for it. The CEO, Kevin Lobo, he summed it up perfectly himself. He highlighted these strong sales and double-digit adjusted earnings. Now, that's not just some corporate jargon. It's a really clear, confident statement that totally sets the stage for what we're about to unpack.
All right, so here's our game plan for this explainer. First, we'll take a look at what made this quarter so strong. Then we'll dig into the real engines of that growth and check out their key strategic plays. We also got to talk about the challenges they're facing, because it's not all easy. And finally, we'll see what this all means for Stryker's future.
So let's kick things off with a big picture of this really impressive quarter. Now, I've been throwing around terms like organic growth and adjusted EPS, but to really get why this is such a big deal, we need to be crystal clear on what those terms actually mean. First up, organic sales growth. Just think of this as the purest way to measure a company's health. It strips out all the noise, from things like currency swings or buying other companies, to show you how well the core business is actually performing. A high number here means one thing: demand is strong. And what about adjusted EPS? Well, this metric is great because it filters out any one-off costs, like expenses from an acquisition or restructuring. It gives us a much cleaner look at the company's real, consistent profitability from its everyday operations. So, that 11.1% growth, that signals real strength.
Okay, so now that we get the what, let's talk about the why. A 9.5% growth rate doesn't just happen by accident. So where did it come from? Which parts of Stryker's business were really firing on all cylinders?
Check this out. While MedSurg and neurotechnology had a very solid 8.4% growth, the absolute standout was Orthopaedics, which grew by a massive 11.4%. This division, which covers things like knee and hip replacements, was just the undisputed powerhouse for the quarter. And if we slice it another way by geography, another key part of the story emerges. International growth was solid for sure at 6.3%. But the United States was the real engine here, just roaring ahead with 10.6% organic growth. Stryker's home market is incredibly strong right now. But hey, that's not to say the global performance wasn't good. The company also saw really strong results from key international players like South Korea and Japan, along with other emerging markets. So while the US was definitely the star, the growth was pretty widespread. Posting great numbers for one quarter is one thing, but the market is always asking, what's next? So let's shift gears and look at Stryker's strategic plays, the proactive moves they're making right now to build an even stronger future. And a huge piece of this strategy is their Mako robotic surgery platform. This is a big deal. They just had a record-breaking third quarter from Mako installations all around the world. And this is so crucial because it's not just a one-time sale. Every robot they place locks in future revenue from their implants, which reinforces their #1 market position. It's brilliant. They were also really busy making acquisitions. Now, these weren't massive company-changing deals. They were smart, what they call tuck-in acquisitions. Guard Medical adds a simpler wound treatment solution, and Advanced Medical Balloons brings new products for patient care. It's all about strategically making their existing businesses even better. And don't expect them to stop there. The CEO made it crystal clear that with a healthy pipeline of deals and a strong balance sheet, Stryker is going to stay active on the M&A front. This is just a core part of their playbook for growth. All right, now it's time for a little dose of reality. No company operates in a bubble, and even in a fantastic quarter like this one, Stryker is dealing with some pretty significant headwinds.
So was it all just smooth sailing? Not quite. The company is facing some serious external pressures that have a real financial impact, and the big one starts with tariffs.
Roughly $200 million. That's the estimated hit they're taking for the full year, just from tariffs. I mean, that is a massive cost that eats directly into profits and has to be managed and offset somewhere else in the business. And on top of that, they're still dealing with supply chain disruptions, which have been hitting their emergency care business pretty hard. Honestly, the fact that Stryker is putting up these kinds of numbers, despite these huge costs and disruptions, makes their performance even more impressive. So when you put it all together, the fantastic growth and the very real challenges, where does what lead them? Let's look at what's next for Stryker and how all this is shaping their outlook for the rest of the year. This right here, this says it all. This is the ultimate sign of confidence. Despite the headwinds we just talked about, Stryker actually raised its guidance for the full year. They now expect organic sales growth to land right around 10%. In the business world, raising your forecast is one of the strongest signals a company can possibly send. All right, let's just boil it all down. Here are the key takeaways. We saw strong, double-digit growth. We know that Orthopaedics and the Mako robot are the key drivers behind that. They've got a proactive M&A strategy to keep fueling growth. They're doing all this while successfully managing major headwinds like tariffs. And finally, that raised guidance just screams confidence. And all of this leads us to one big final question. When you see this kind of powerful momentum and combine it with a clear, active strategy for the future, is Stryker building itself to be the undisputed leader of the medtech industry for years to come? Based on this quarter, they're making a very, very compelling case. Thanks for joining this explainer.